Had some data hitting the wire. It looks like building permits coming in, while down 4.4%, still a little bit above expectations. Housing starts a little bit below anticipated levels, and well, not a lot of movement here in terms of the dollar. Again, this is probably not the most heavily traded on number, but definitely going to help us get some more insight in terms of this higher rate environment, the impact it's having on housing. Again, I want to start with the housing starts, which came in up 7% for the month over month for September. That's after a revised down, the revision from last month's number, down 12.5% at 1.358 million units. That came in just below anticipated levels. Building permits, as I mentioned, down 4.4%, and building permits here at 1.473 did top analyst expectations here. I want to bring in Bob Iaccino, founder and chief strategist at Path Trading Partners, for a look at the data. Bob, good morning to you. Kind of mixed, it looks like, here this morning.
Yeah, I was on last month when these figures were released with you, Ben, and we talked about it at that time. When last month we saw building permits up 6.8 and housing starts down 12.5%. And now you see the flip of that. And that happens a lot with this particular data set when they're not ebbing together, when they're not going in the same direction. And a lot of that has to do with, as you mentioned, the flow of the actual sale of these new homes. You don't apply for new permits if you have inventory, or if you have unfinished inventory that's as a home builder, obviously, that you're going to need to sell with rates even higher than they were last month on the 30-year fix. So this makes sense to me in the way that they came in. Next month will actually be a very key set of this data, because if you see building permits down or flat next month, and you see housing starts down or flat next month, then you look for that to be a potential breaking point for housing, because that means the homes that they built aren't selling, and they're not applying for new permits because they don't expect the ones they have in inventory to sell. When you see them shift back and forth like that, that's sort of the normal ebb and flow of this particular set of housing figures, although the levels themselves can be gauged versus the last levels. And this particular level of building permits down 4.4% is not that dramatic when you consider they were up 6.8 last month.
Bob, is that shift, that ebb, that flow that you're talking about, is that also a reflection of what we're seeing in terms of higher rate environment, and how, well, we've been talking quite a lot about investors coming to grips with it. Maybe home buyers are as well. Ultimately, we pointed out the MBA numbers earlier this morning, a bit of a disappointment.
Yeah, this has been talked about ad nauseum. I'm not the first or the last person to say this. When you have people in mortgages that are in the range of 2 to 4%, they're just not moving.
Yeah, no incentive.
They're just not. Actually,
right.
If we get a boost in the economy, a sort of pickup in the economy, and we see that longer term rates, well, let's just say rates in general, aren't moving lower yet, you're going to want to look at things like Home Depot and Lowe's, simply because you'll see people adjusting their current homes rather than switching into new, larger homes. That's a shift that historically has happened in the past, where those particular housing improvement stocks have gotten a little bit of wind behind their sails, simply because the rates are not low enough yet for people to consider it. I remember my father having an 8% mortgage. I was just talking to an older friend of mine who said he remembers doing a dance because he got 7%. So these are not historically unusual levels of rates, but all you keep hearing about is how the rates are oppressive and way too high for people to buy homes. Either home prices have to come down, or rates have to come down, or the housing market to be considered healed from this little cold that it has right now.
Bob, or employment has to slow, maybe? I mean, I've been arguing for a while, strong employment, the conditions we're seeing right now in some ways fuels this, and home buyers' ability to kind of stomach this higher rate environment.
Well, homes will be the first things to drop, right, Ben? I mean, we're seeing strength in consumer spending. So even with inflation falling, we had strong retail sales. Remember, retail sales not inflation adjusted. So even with, let me correct myself, with the rate of price increases slowing, because prices are still increasing, as we've talked about many times, you saw retail sales still strong. Many analysts expecting a decent holiday season, at least level from last year, if not higher. That's where these strike-induced and wage-induced increases are going to be spent on holiday spending. They're not going to be spent on homes, because that's not a big enough drop yet. So yes, if we see labor start to suffer, as you said, then we see home prices start to fall. simply because people will have to get out of their homes and they'll have to downsize as opposed to right size or upsize.
Yeah, it seems to have a bit of a domino effect at a certain point here. It doesn't feel like the Fed speakers are really pushing back on this situation much at all either, right? Talking about how rates have done the heavy lifting for them and in many ways maybe cheering this move on.
Yeah, we've got an important one tomorrow with Jerome Powell speaking, and they've all seen how we've interpreted the speak that we've had, right? From Lori Logan to Michelle Bowman, both saying what you just mentioned, that some of the longer end rates will do some of the heavy lifting for the Fed, and that may mean they don't need to go again. But then yesterday we saw that in the last minutes, Cleveland consortium of the Fed meeting, the Cleveland Fed President Loretta Mester and her team wanted another 25 basis points at the last meeting. And we're seeing that probability increase ever so slightly. As of yesterday, 88% that rates were going to be unchanged. We've gone as high as 93% prior to yesterday's drop. So you're seeing that in the data itself. This housing data won't spook the Fed. It won't change their minds about the next meeting. But as you go into the December meeting, there's a chance there's going to be a 25 basis point rate hike. And tomorrow's speech will tell us whether Jerome Powell appreciates the way the market has been responding to the recent Fed speak, or whether he's going to contradict it at all. That'll be the key speech. When you've got this much Fed speak and it includes the chairman is the one that matters.
Bob, talk to me lastly about the market's ability to stomach it all. I've been saying a win for the bulls in many ways. You got geopolitical tensions. We're seeing a reflection of that in gold, right? A spike up from 1820 up to 1950, 1960 now. And the indices, the S&Ps throughout it all hanging out pretty comfortably in the middle of the range we've been in since June, right around 44.
Yeah, when the initial conflict flared up in the Middle East, we saw gold rise, we saw yields fall, but we didn't see equities drop initially. And crude oil on top of that. Crude oil spiked on Friday, but it spiked initially as well. Friday, it actually rallied above the initial spike a week ago last Sunday. So from that perspective, we saw a partial flight to safety, not a full flight to safety, because equities didn't fall off. I would suspect that equities will follow gold bonds if they move together. If we see yields drop, which is not happening today, yields are flat from a big rise yesterday. If we see all three major things, including the dollar, which would kind of be the fourth, sort of the stepchild of this whole thing, then you're seeing a real flight to safety based on geopolitics. We haven't seen it yet.
I agree. Stocks has still hung in there pretty well. We haven't seen the selling on that end, although we have seen some buying in gold. Appreciate you joining us here, Bob Iaccino from Path Trading Partners, to bring in a look at markets in terms of some products to keep an eye on.